meeting this morning. I hereby call the meeting of the Finance Committee to order at 9 a.m. Due to the COVID-19 situation and in accordance with the new live streaming law, this meeting is being conducted via video conference and being live streamed on the MDTA Finance Committee page. All members will have their video active during the entirety of the meeting. I ask that anyone who is presenting or answering a question to please turn your video and audio on when speaking. When you are done, please turn your video off and put your audio on mute. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. There are no members of the public who have pre-registered today at this morning's meeting. Due to the length of this morning's meeting, we will be taking a short 5-minute break after agenda item number 11 is presented. Please note that we will continue to live stream during this time and would appreciate if everyone stayed muted during the break. At this time, we will move on to agenda item number 1, the approval of the open meeting minutes from October 6, 2020. I will entertain a motion to approve the minutes.
So moved. Member Carroll.
Thank you. Is there a second?
Member Ardinger, seconds.
Okay, we have a motion and a second. All those in favor?
Aye. Aye.
Aye.
Okay, motion carries. Thank you. The minutes are approved. Item number 2, contract number MT3134 janitorial services for Point Breeze. And presenting is Carol Hicks. Good morning, Carol.
Yes, good morning, Mr. Von Paris. Hopefully everyone's doing well this morning. And can you hear me?
Yes, loud and clear. Very good. Thank you. I hope you're doing well.
Yes, I am. Thank you. Contract MT3134 is for janitorial services for the Point Breeze campus, which includes the headquarters building, 2310, the Emergency Operations Center building, 2330, and another small facility, 2340. The janitorial services is for 5 days a week, but I will explain a weekend work that's for one of the facilities. The contract provides for all of the cleaning services and supervision. It provides for supplies, labor, and equipment at those facilities. This contract is performed by a community service provider in accordance with the state of Maryland, the Code of Maryland Regulations, Title 21-.11.05, and pricing is from a certified sheltered workshop under socioeconomic policies and guidelines. The Pricing and Selection Committee approved this item on September 19th, and the contract will start on December the 3rd of this year, 2020. The service provider is the NCIA workshop or facility or organization, and they have been providing this service for the last 5 to 7 years at the complex. Building 2310 will have the 5-day-a-week standard janitorial services, and it will have a new phase to it this time, which will be a day porter. The day porter will be 5 days a week from roughly 12 noon to 4 p.m. And the purpose of the day porter will be to do a cleaning that's needed throughout the building in critical areas during the day, and also during the lunch areas that will be used around that 12 o'clock time period. Building 2310 will also have a 5-day-a-week services, which typically are performed after hours. After hours meaning from 4:30 to about 5 to 6 o'clock or so. What's new with Building 2310, which is a 24/7 operation facility, it has our IT folks for this week, but also 24/7 in terms of dispatch operations and the emergency operations personnel, and they work 24/7. Therefore, this a new part to this contract will be a weekend cleaning and holiday cleaning, so that it will provide a true 7-day-a-week cleaning of the critical areas in that facility, so that folks who are working the weekends and holidays will have the restrooms, the break areas, and the basic trash removal 7 days a week in that facility. And Building 2340, a smaller facility, will have strictly the 5-day-per-week facility cleaning. The term is a 3-year base with 1 2-year renewal. There's no MBE or VSBE goals. The base year of the contract is $755,493.84. 2-year option renewal is $561,150.32, and the total for the 5-year contract is $1,316,643.16. And I believe that pretty well sums up the highlights of this contract. Are there any questions?
Any questions from any of the members?
I'd like to make a motion that we approve this contract.
Okay. Thank you, Member Rosen. We have a motion to approve and advance to the board for final approval. Is there a second?
Second that, Member Carroll.
Member Carroll seconds. We have a motion and a second. Any further discussion? Okay. If not, we'll call the motion. All those in favor?
Aye.
Aye.
Okay, it's unanimous. Thank you very much. Motion approved. And thank you, Carol.
Oh, you're welcome, sir. Thank you very much. You're quite welcome. You all have a great day.
You too. Thank you.
Very welcome.
The next item up is an update from the independent auditor's report on fiscal year 2020 and on the financial statements. We have Chantel, and we also have guests, Sean Walker and Jitana Coleman from CLA. And Chantel, welcome. Good to see you.
Thank you. Good to see you. Good morning, everybody.
Good morning.
Morning. I am pleased to report that the Transportation Authority recently completed its annual financial statements audit for fiscal year 2020. Today, our independent auditor, Clifton Larson Allen, is here to update the committee on the results of the financial statements audit. We are joined today here by Mr. Sean Walker, principal in charge of the authority's audit, and Mr. Tana Coleman, director of CLA state and local government team. And with that, I will turn it over to Sean and Jitana to provide the committee with an overview of the audit.
Hello, my name is Sean Walker. Jitana is actually not with us this morning. Something came up with her, but I am more capable in carrying it out from this point. Do we wanted to share the presentation, or did everybody receive a copy?
We could, if you go over maybe, I guess, just the highlights. Is that what you? Yeah, and then we'll all receive a copy unless there's any members object to that.
The members do, Sean, have a copy of the presentation in their materials.
Okay.
Okay.
Very good.
Thank
So really what I wanted to go over real high level is the audit overview, just talk about the audit in and of itself, a discussion of the existence or non-existence of internal control deficiencies, some required auditor communications, and then some future considerations for the authority to consider. I had a list of key players here. Obviously, myself was the principal. Keith Novak was our quality control reviewer. He has some experience with the authority. He used to be the principal in charge the first time that we did the authority's audit. And just at a point of pause, if you guys didn't realize, there was a switch in auditor this year. We did the statewide contract did go out for bid, and you are part of the statewide contract now, and they were selected us as a firm. We had Jatana Coleman, which was the director, and then we had Kristen Rohr, which was a senior, and then we used FS Taylor and Associates as our DBE partner on this for a disadvantaged business enterprise. We were able to issue an unmodified or a clean opinion on the financial statements. We had several areas of emphasis which we look at as part of the audit. Some of those are investments, capital assets, long-term debt, revenue, intergovernmental agency relationships, and also the financial reporting and how that is all pulled together. As far as internal controls, we did evaluate internal controls for design for significant accounts and classes of transactions. We determined that there were no material weaknesses or significant deficiencies that we've identified. What does that mean is that as part of our audit, we do look internal control. We do not audit internal control for effectiveness, but we do go through and look at key control areas. And if we determine that we find anything that could create a material misstatement, we would classify those either as a material weakness or a significant deficiency. We did not identify those types of control deficiencies. As far as required communications with you, significant accounting policies are located in the footnotes of your financial statements. There was a change in accounting policy this year that you'll notice. And this is dealing with the toll revenues and it being recognized on an accrual versus more of a cash basis. It was a management's determination to make that policy change. So you'll see there's a restatement footnote number 12 in your financial statements that outlines the effect of that. But basically, with the overall tolling, and the way that that works is that we can book a receivable at the time of the person has gone through the toll. And when you have to, the video tolling, when you have to go through and collect, it creates a receivable. So they did put that on the books. Another, as far as accounting estimates, significant estimates in your financial statements, the allowance on receivables, pollution remediation liabilities, capital asset depreciation, and pension liabilities are the largest estimates on your books. Obviously, management comes up with a methodology for determining the amounts that are on there based on accepted methodologies. We look at those and ensure that we are in alignment with them, management on those, and we are. So we feel pretty good about those estimates. Like I said, there's significant statement disclosure. There is a restatement. Again, that's in note 12. It is not a correction of an error, it's a change in accounting policy. We did not incur, other than working in a really remote fashion this year, we did not have any difficulties performing the audit. Everybody worked well. We appreciate their efforts of pushing this thing along. It actually was a very satisfying project management for us. It went pretty smooth. There was one, and if you got the PowerPoint, there was an error on here as I was preparing the uncorrected misstatement. There is a transaction that wasn't recorded. You've changed toll processors from your and in the implementation of that, there was some delayed revenue that was not booked. About $7.5 million of video toll revenue. It's not material to your financial statements, but it's enough to make you aware that it's there. It was not booked just because of the delay and the implementation. Corrected misstatements, there were none. We did not have any disagreements with management over accounting policies or anything along those lines. We did obtain representations from management. You will receive a copy of that representation letter in a further communication that will be sent. We did not have consultation with any other accountants on any policies or procedures. We did We didn't have any significant issues to be discussed with management prior to being retained. And then as far as when you use use the financial statements and say that they're audited financial statements, we like you to use the financial statements in its entirety. Some future considerations. Obviously, you know, the Government Accounting Standards Board is always busy issuing new standards. There's some that are out there that are interesting for the authority to consider more specifically. One is in leases, and the issue there is that operating leases are no longer in the upcoming year are no longer, or actually in 2 years, are not no longer allowed. They're all going to be treated like capital leases, so there will be a balance sheet impact to the leases. So you just need to be able to identify those and do a calculation to determine how they will impact the balance sheet. Fiduciary activities, you know, as being the type of agency you are, you may have some fiduciary responsibilities, holding money on behalf of others, et cetera. Pension and OPEB plans, et cetera, that will need to be disclosed if they aren't already disclosed. So we're just going to look at that in the upcoming year. Then there's also subscription-based information technology, and this is getting into the whole idea of cloud storage and the different types of software packages. Sometimes there's a fixed asset element to it when there's a that you may need to record, but we'll take a look at that. That's just an interesting standard to take a look at in the future. So there are some changes. The other change here I'd have to offer is that there was a change to TransCore as a service organization for tolling activities. You know, that changed mid-year, not quite mid-year, towards the end of last year, and obviously that has some changes that we'll have to look at with SOC reporting and et cetera. Other than that, I mean, I'll take any questions you have.
Any questions from any of the members? I do have a question, Sean. On when we talked of the lease, are you talking about like the leases?
Yeah.
Is that changing to some leases? I've heard both, where sometimes a lease could be you know, more positive and versus a long-term liability, depending on the is that shifting to a long-term liability, or what was it?
Yeah.
What is
the big change here is that back in the there used to be a capital lease where you would actually book, and this is on both sides. If you're a leaseor or a leasee, you would book either an asset or a liability associated with the commitment to the lease, and you would book the asset that you are receiving as part of that lease arrangement. So that's what it's really going to. All leases will go through that process. Before, you could classify some as operating leases. Like, for example, if you were renting a building from somebody, you would consider that to be an operating lease, and you would just pay as you go. I think the big change here is that those types of leases need to be reconsidered and make sure that they are recorded correctly, in the sense that they're going from operating leases are no longer. So we have to go through this exploration of capital, the kind of capital lease. I don't know if anyone else on the call has a exact impact or some areas where that might rear its head for the authority.
Good morning, this is Deb Sharpless. Members, we have 2 leases that I'm aware of that, and both of them, you know, in the grand scheme of things are quite immaterial to us. We have one next door at the 2400 building, and then we have one lease at the White Marsh office.
Thank you. Any other questions?
I do have a question in regard to the fiduciary activities. Are you referring to activities such as when we're issuing bonds on behalf of other organizations, third party, but we're not also not liable for those? So can you just clarify what type of activities you're referring to?
No, that particular activity is more of I think that's more related to That's a different, that's not, I don't think falls under the standard. I don't know, Deborah, Deb, if you actually looked at it from that standpoint, but this is, the big impact here is in when you have, if you have OPEB and pension plans, if you got an investment trust, which, I haven't really looked at how you do that in detail yet to see if it would qualify, but I don't think you have those funds trusted. The other side would be custodial funds, which would be things that you're holding on behalf of others. A lot of times, I don't think you actually have any of those custodial funds. A lot of this wouldn't be booked already because the fact is there's an exemption for BTAs not to book fiduciary activities. So it's something that we got to look at carefully just to make sure we ask around to make sure we got all the exposure. I don't know if Deb, you've done that. This standard was supposed to go in this year, but due to the COVID, it was delayed 1 year. So there might have been some work by management already to determine whether it's applicable or not.
Yeah, I'm not aware of how much work we've done in this area, but as the members know, all of our money is held in trust, and we account for every dollar that we have. So we'll have to look into this further and figure out if this is more a footnote disclosure for us, or somehow it changes our accounting practices. But we'll be doing that. If it has any impact to our financial statements, we'll make sure that we update the committee members prior to next year's financial statement cycle. And then the conduit debt is what I still call it. No, I don't believe that falls under the fiduciary activities.
No.
Deb, could you update us either way on that?
Yes.
Based on your review?
Yes.
Thank you. Any other questions? Okay. If not, Sean, thank you.
Thank you.
And we will move on. Thank you very much. For another update, item number 4. And Chantel will present fiscal year 2020 closeout of key financial metrics. Chantel.
Thank you. This morning, I will be providing the committee with a brief overview of the agency's fiscal year 2020 financial closeout as compared to the January 2020 financial forecast. To clarify, the January forecast is the same forecast that was approved in November of 2019 by the board and reflects anticipated revenues and expenses prior to COVID-19. Turning to the table on page 2, you note that total revenues were about $100 million below the January 2020 forecast. Divergence from the January forecast is primarily due to COVID-19. Capital budget spending exceeded the January forecast estimate by $35.3 million, which was mostly due to the acceleration of cash flows for the Nice Middleton and I-95 projects. Underspending in the operating budget of $34.6 million nearly offset the higher than anticipated capital budget spending. The operating budget was below the January forecast due to cost containment actions that were taken in response to COVID-19. You may recall that this included a hiring freeze and a concerted effort made by all the divisions throughout the agency to reduce spending and to defer certain purchases. Debt service was in line with the January forecast, whereas the authority's bonds outstanding and unrestricted cash balance exceeded the prior forecast by $365 million and $213 million, respectively. This was a result of bond issuance proceeds from the 2020 toll revenue bond issuance that were used to finance capital project expenses due to lower than anticipated toll revenues, and funding that was used to reimburse the authority for prior pay-as-you-go capital expenses. While the agency's rate covenant and debt service coverage ratios were below projections as a result of lower than anticipated toll revenues, you note that the authority met or exceeded all of its legal and/or policy requirements. And that concludes my presentation. I'd be happy to respond to any questions that you may have.
Any questions from any of the members?
Member Ardinger, I have a question. The 100 million reduction in projected revenue, how much of that is due to decreased traffic? And is there any part of that that we think could be collected due to just a delay in collection?
Member Arnger, this is Deb Sharpless. I think when we do the next item on the traffic and revenue forecast with the graphs and all that we have, we'll be able to answer that question.
Okay, thank you.
Any other questions? Okay. Chantel, thank you very much. Thanks for the update. We appreciate all you do. Thank you. We will move on to item number 5 on the agenda. Another update, traffic and revenue forecast update. And Deb will present on that.
Good morning again. Before I present this item, I wanted to address for a second the next items number 5, which is this one, through item 10, because they all fit together as we walk through this. We're going to start out with the traffic and revenue forecast, which was just updated in November. And then we're going to move on to reductions in the fiscal year current operating budget. Then we'll transition to the approval of next year's operating budget, the capital budget. Then we'll talk about a cash refunding for fiscal year 21 and 22. And then all of these items are pulled together in the financial forecast. And at the end of the financial forecast, you'll be able to see that when considering all of these items collectively, the MDTA adheres to all of its financial standards. And in some years, we have a decent cushion that's intentional because there's still a lot of uncertainty with COVID. Okay, so I just want to start off with that so that we can talk about how all of these items fit together. And then in October at the board meeting, I verbally discussed these items. So this is the first time that we're formally presenting them to you. And other than minor adjustments, everything that we're presenting to you today is consistent with what we talked about in October. So, before I begin, is there any questions? So with the traffic and revenue forecast item, we've given you a couple pieces of information. We have a summary memo that we generally provide you. I'm going to speak from some graphs that are included, but we've also included the traffic and revenue report from CDM Smith. And so, yes, let's to begin with, I'm advancing to figure 1 and 2. And I'll begin with COVID and the impact that COVID's had on our revenue. So these two graphs that you're looking at, the first one is the ICC and the ETLs. The figure 2 is the legacy facilities for passenger vehicle. And if you go to the next page, it is the legacy facilities, which is everything except for the ICC and ETLs for commercial traffic. So beginning with the ICC and the ETLs, you can see that when COVID first started, we had a very, very steep decline in traffic and in fact revenue, and we plateaued around April 15th. And since then, we've had an increase, but it's been a prolonged recovery and not nearly the steepness of the recovery that you see with the legacy facilities. But also this lower recovery is what was assumed in the forecast. The ICC and the ETLs, they're congestion-based facilities. And so with lower traffic volumes, there isn't as much congestion. And therefore, you would expect this recovery to be slower than our other facilities. So since July, time period, other than holidays, you can see that we've been very flat. You know, little bit of peaks, but slight incline, but by and far very, very stable. Yes, we're 40% roughly below where we were pre-COVID levels, but we're not seeing any sharp increases or sharp decreases. So what this means for us is that the forecast that we're going to talk about, the assumptions about COVID, they're not changing the forecast right now. The stability that we have here is what's reflected in the forecast. So if I move down to passenger facilities at the legacy figure 2, sorry, you can see that the incline is steeper. And we get to, in July, we were about 20% below. Now I think it's 17, 18% below where we were pre-COVID levels. But the recovery was much more steep. And again, we've been very stable since July, with the exceptions of peaks during some holidays and some downward with the tropical storm. So now if I'm going to move to the next graph, is the commercial traffic. And commercial traffic also, it declined and we plateaued at April 15th, same as all the other facilities, but you can see that the decline wasn't nearly as steep with commercial traffic as it was with passenger vehicles. We recovered around July. Again, holidays affect, weather affects commercial traffic, but we've recovered to pre-COVID levels with commercial traffic. So what the takeaway with COVID is back in when we started doing the forecasting for COVID, we were around the March and April time period, and that's what produced the June forecast. And now those assumptions have been updated. CDM Smith has applied a little bit more conservatism with COVID at 3% adjustments, but we're stable at this point in time based on the information that we have. Next, I'd like to actually refer you to a page in the report. It is page 4-2. And this is, I want to start to talk about the actual new forecast that we have. First is, you know, there continues to remain a considerable amount of uncertainty with COVID. You know, we have businesses that are continuing to experience significant financial hardships, pessimistic consumer confidence. There may be long-term shifts in institutionalizing telecommuting and e-commerce. So all of that creates some uncertainty with our forecast, which means that we need to continue to have ongoing monitoring of where are we in relation to our forecast. Now this forecast on the table, it's 4-1, and it can be found on page 4-2, is the list of assumptions that went into this forecast. Now, these were the best known assumptions we had at the time of the forecast was put together. And throughout this forecast period, some of these assumptions will change. Now, many times they're offsetting assumptions, and I'll point one of them out as we go through this. The first assumption is that it obviously assumes COVID and the impact that it has had on our traffic. We also incorporate adjustments for construction. The I-95-895 project, the I-895 bridge replacement project, sorry about that, is a perfect example of that, where the forecast reduces traffic because of the impacts of construction. This forecast also assumes permanent cashless tolling. The June forecast that was updated, that did not assume AET. The next one has to do with video toll rates. We have been charging the cash video toll rates at 5 of our facilities. This forecast assumes that we return to the video toll rate effective January 1st. It also assumes that notices of toll due would begin to be mailed on October 15th. That occurred. It also assumes that we would process 1.8 million video transactions per month beginning in January. And from mid-October to January, we would have a ramp-up period. I'm going to circle back to that one in just a second. It assumed this civil penalty of $25, which was an action taken by the board. Also, that was part of the prior forecast. It assumes vehicle registration holds for non-payment would not occur in fiscal year 21. That's a conservative measure, as well as CCU tax intercept would not occur in fiscal year 21. It assumes pay by plate and early NOTD discounts and vehicle classification changes. It assumes that that would not occur until 3G goes live. The classifications would happen 3 months later after go live. Now those dates have changed. And again, I'll circle back to those in 1 second. Commuter and shopper discount programs would restart November 1st, which has occurred. And the forecast is based on a cash basis. So a few minutes ago, Clifton Larson Allen was talking about the financial statements are on an accrual basis, and we began recording video receivables on an accrual basis. This has been a plan for MDTA for some time now. We were trying to tie it to the transition, but with the conversion of AET, we felt like we needed to make that change this year. So even though for financial statements an accrual is the standard to which to do financial statements, even though we've made that accounting change, when it comes to our rate covenant or our debt service coverage, that decision has no bearing on these numbers. There was nothing done to change revenue in a particular year. For this purpose, everything is on a cash basis, meaning when it's paid. So to wrap up the assumptions, right now, as we've started to mail video tolls, and we are right now we're approaching 1.3 million. We're working on being able to increase the 1.3 million to 1.8 million. But even though we're working on that, I still ask the question, what if? What if we were not able to get up to the 1.8 million and we stayed at 1.3? And I just assumed through April for concern. The impact is estimated at $2.3 million reduction in revenue in fiscal year 21. Now, other things impact that. We've also assumed a payment rate of 50% at the NOTD phase. So the number of transactions that are processed, the payment rate, all of those can affect the forecast. And then the other one is with the pay by plate and early NOTD payment options. They were assumed earlier than what they're going to occur. By those items have an offsetting effect to reducing or not mailing out as many NOTDs, because the delay in those actually increases revenue. So each one of these assumptions that's in the forecast, it was the best information we had at the time of the forecast being put together. But we recognize, as we do in other years, we have to continually monitor where are we in revenue so that we can make a determination if further adjustments are needed. So let me pause for just a second, and then we'll talk about our actual traffic and revenue forecast. Okay. So I guess beginning on with figure 4, I'm back to your board materials. This is page 7 of your traffic and revenue forecast update. The first graph that you see there is traffic for the legacy facilities. And for each one of these subsequent tables and graphs that we've prepared, you'll see that we're comparing 3 forecasts. We're comparing the forecast of October of 19, essentially a year ago from this forecast. Then we're comparing to June, which is when we update it for COVID, and now the November forecast. And the primary changes between the November forecast and the June forecast is AET, the timing of mailing the NOTDs, and the timing of transitioning back to the cash rate. Other assumptions are largely the same as the June forecast. And so, Member Oringer, if I understood your question correctly, you were asking about the impact of COVID compared to the impact from business decisions, such as AET and mailing NOTDs. Is that correct? Okay. So I'm going to, okay. So starting with traffic, so this is not a bad news story, that what's happened here is this, this curve, I call it a shift, right? So the curve has shifted down. When we look at this, and these are paid transactions, right? If we would kind of take this line and follow the same shift, that bottom of that triangle is largely associated with the lag with mailing NOTDs. The rest of it is we will have leakage with AET. Cash customers today, some of them will get through. It's part of AET. It's industry standard. Everyone has a little bit of leakage because you didn't get a vehicle's image. That's what caused this shift down. That's the bulk of this from a traffic perspective. Now, with that, when we get over to revenue, you'll see how AET doesn't affect us from a revenue perspective. Okay, so I'm gonna move to the next slide. So for figure 5, now we're looking at revenue for the legacy facilities. And so what's happening here is in this situation, this V here, this is a combination of the customer focused decision to delay the mailing of NOTDs and charge the cash rate. That is this V as we transition back over to video tolls, and as we are mailing out NOTDs, they've started midway in 2021, right? Because we're just about halfway through, and you can see the revenue starts increasing. But this increase in revenue extends well into fiscal year 2022 as we work down the volume of notices that need to be mailed. And so what this is important to show is from a cash flow and impact, we're dealing with a short-term problem. We're the subsequent strategies that we talk about for the 21 budget reductions, the cash refunding, each one of these, we're focused on this V that I've talked about to address this. And then once we get through this backlog, you can see revenue is back up and where we were prior to the June forecast. And that's with AET, because with cash customers, some of them, and hopefully a lot of them, will open an Easy Pass account and therefore pay a lower toll because of the Maryland Easy Pass rate. Other customers will choose to be pay-by-plate customers with 3G and pay the same toll rate, and other customers will choose to be video toll customers and pay the higher toll. So when you offset all of them together from a revenue perspective, even though there's some leakage, the lane revenue comes back to where you were prior to AET. So if there aren't questions right now, I'm going to move to the next.
Any questions? Deb, I have a couple of questions real quick, if it's okay.
Absolutely.
The assumptions, the assumptions regarding revenue streams, I guess it's a lot of this hinges on the success of our success with the backlog, the success with the implementation or the conversion to 3G, and and I guess the ability for us to, and I think you indicated that, the ability for us to be able to process at a higher rate. So that is, I guess, a lot of people weighed in on this in the decision here. I would hope on the ability for us to do that, and then the also the timeline. If it drifts from the January timeline, if it drifts further on the implementation, I guess not only will we have potential revenue issue here, but there's probably associated expenses that go with that for the running of dual systems, and also probably some other fees that we are charged to, I guess, from consulting. I don't want to go too deep into that, but there are my questions or concerns based on the material that we just received here.
Let me, if I miss any of them, please let me know. Let me start with transition. And transition fully expected to be beyond January. And so that's why I went and had the calculations done to understand the what if we were not at 1.8. We are certainly going to work to do so. We've taken steps that, and we've moved transactions, or and continue to do it every single day, to move transactions from CAPS that we originally planned to send to TransCore. We have been sending them over to Conduit system. So Conduit is mailing the NOTDs and operating the call centers. So we're taking steps so that we can continue operations with Conduit. Now, from a cost perspective, with TransCore, we don't have any times where we're paying two vendors for the same services. Because these transactions are being processed by Conduit's being paid for them, TransCore is not being paid for any of these transactions. Now, with CAPS, as they get closer and closer to being ready to enter what we call phase 3, the acceptance period, there certainly may be some delays or reprocessing that costs that we incur with CAPS. So in other words, they were set up to send these transactions over to TransCore. Well, now they have to rework things and send them over to Conduit. So there is cost associated with that. So that's, from a 3G perspective, that's the largest impact on the revenue because of not transitioning. Would be those two things, is us working to get up to the 1.8, which before the forecast, the 1.8, was verified. Now we're running into some unanticipated issues. And we're going to do our best to work through those and make adjustments if we need to.
Thanks for the update. I do have one last question. The shift, when we shift from cash, from accrual to cash, but we went the other way, didn't we? Yeah, from cash to accrual, right?
Yes.
What did we?
For financial statements purposes.
Yeah. So what did we figure for bad debt on the video? Did we factor anything in there?
Oh, absolutely. And you know, I don't have the spreadsheets with me right this minute. But what the revenue unit led by Cheryl Lewis-Orr, what her group did, working with Easy Pass Operations, we went back and we looked at our payment rates for all since the beginning of video tolling, fiscal year 14, and we tracked the payment rates that we had for each one of those years, and then we also circumstances exist where we waive civil penalties. We also accounted for that as well, and based on that historical data, we recorded the receivable as well as an allowance for doubtful accounts. Now, because of the change in accounting principle, the allowance was only set up for the current year. Any, bad debt unpaid from prior years was reflected in revenue, because when you restate, you net revenues and expenses together. So that was absolutely done. We can follow up with you to let you know what the receivable was, as well as the allowance for doubtful accounts. And when doing that, it's your realistic expectation, but there's also a level of conservatism placed on there, because the last thing we ever want to do is overstate our receivables. So our allowance, it is very likely higher than what it will actually end up being, but that's because had we not done that, we would have overstated the receivables.
Okay, thank you.
Yes, and just one more thing, that accounting financial statement decisions is not reflected in this traffic and revenue forecast, and our financial forecast. Everything from that side is done on a cash basis. So the decision to record the receivables had zero impact on our traffic and revenue forecast or on the financial forecast.
Thank you.
So if there aren't any other questions, I'm going to move to figure 6. And now we're looking at the ICC. And for the ICC, with traffic, this graph for the board materials, it will be updated slightly, and I'll address that in one second. But you see the 3 forecasts again. The dark solid line is the current forecast. That same V that we've seen in others is because of the lag, but you can see how it's not quite as steep. It's closer to the June forecast, and that's because these facilities were already AET. So this is only reflecting the lag in NOTDs, and the cash versus video toll rates didn't apply to these facilities. And so you can see that we're recovering in 22, and then we're starting to exceed. Now, this little dip below, when we get out in 2025, that was an error on our part. We grabbed the wrong graph, that we have the ETL extension. And so here's the extent. This dotted line includes the ETL extension. This one does not. We will correct that for the full board meeting. Okay, so now I'm going to move to the next figure, which is revenue. And, you know, when we here, you can see how, you know, same V, and then we're recovering. So it's a consistent message across all these facilities. And the last figure is looking at total administrative revenue. And so that is unused commuter plans, payment of civil penalties, very steep decline because of NOTDs. But then it ends up exceeding prior forecasts because when we have higher video toll customers, we're going to automatically have some additional customers paying civil penalties. And that's what's reflected here. And the last slide takes all of this legacy ICC administratives and puts it all together. And you can see the short-term problem cash flow issue that we're working through here in fiscal year 21 primarily, and somewhat in 22. And then revenue recovers slightly above where we thought we were June of 20. So with that concludes the wrap up of presenting this. We took the approach of the graphs instead of walking through the report for this item. You know, it's a very comprehensive report, but we're still happy to answer any questions regarding your materials or the CDM Smith report.
Hi, Deb. Just a quick question in regard to the assumptions. It's clearly a detailed list of assumptions. I guess more generally, how conservative are we now? I know in the early days of the pandemic, there were a lot of unknowns. There's obviously still a lot of unknowns, but we know a lot more. So if we're thinking worst case scenario, does this list really comprise that when we're looking at dates and when certain things get enacted and so forth? We're just, I guess the big thing, I was just hoping to minimize surprises going forward.
So Member Rosen, starting with COVID, I have to flip through the pages, but CDM Smith incorporated a 3% reduction above and beyond where they were before to address for some conservatism and uncertainty with COVID. And I think, you know, COVID is still our largest risk. You know, if this is a horrible winter and we get into a lockdown situation, you know, the COVID forecast has some assumptions, but not to an extreme. And that's where we'll have to monitor. And depending on what happens to COVID, there is always a possibility that we're going to have to make further adjustments. We've taken in the other actions, we've taken some actions to help reduce our risk in case that happens, but that risk still exists. When we go down the other lists, you know, there's a lot of certainty with the construction assumption, especially with the 895 assumptions, because that project is starting to wrap up. We've put adjustments in the past involving traffic when we have construction involving the Bay Bridge. So we have experience with doing that. With the returning to the video toll rate, that, you know, we've begun to do notifications. That the uncertainty pieces is how far above the 1.3 are we going to get to from notices. We only assumed a 50% payment rate which has a conservative element. We certainly expect much higher than that. When we looked at the backlog before, the average amount someone owes, if I'm remembering right, was like $20. And, you know, 80–90% of people, owed in the $10 range. So with those types of outstanding amounts that customers owe in this backlog, we certainly anticipate a higher payment rate than 50%. But for planning purposes, that's what we assumed to do in order to have some conservatism built in. So, but it is absolutely a monitoring activity that needs to continually be done. That's also reported out to the board. Like, part of this agenda being very long is this is a quarter that we normally give you updates, quarterly updates. So you'll receive an update on the operating budget and the capital and the traffic and revenue forecast for the first quarter. And we will continue to do that, if not more frequent, if that's what the board members desire.
Thank you, Deb.
Hey, Deb, I have a question for you. When you look at the assumptions, assumption 5 or 6 says no major recession. Is there any calculation for any type of economic contraction that goes into the assumption or forecasting that's been done?
Yeah, the COVID assumptions assumes a longer recovery, not a steep recession, but it assumes a very prolonged recovery. And when we look at our graphs, you can see. So I'm looking at figure 9. That so the gray dotted line is pre-COVID, and you can see that in the forecast, even now, we are below that forecast, 10 years out. And this being below pre-COVID levels is assuming a prolonged recovery, not a steep recession, but a prolonged recovery, which is the approach that the traffic and revenue consultants think is the most realistic.
Thank you.
Deb, I have a question. The assumptions, getting, I guess, on the same topic of assumptions, how do we stack up or align with the industry, the tolling industry, with our assumptions as it relates to what Member Carroll mentioned, and or of course COVID? Do you think is there any kind of, are we aligned a bit with the industry on this, or does that have to be further evaluated?
I would answer that question by, I would be surprised if we are not. Our traffic and revenue, it's an investment grade traffic and revenue report. Our TNR consultants are CDM Smith, nationally recognized firm, huge portfolio of toll agencies that they provide traffic and revenue reports. And you can see, their methodology and their standards for the firm's philosophy is consistent from client to client. And you can see all the economic factors and everything that they consider when performing this. So their standards in how they put together traffic and revenue reports, they're consistent across all agencies, and especially with regard to COVID. Where the other assumptions, that's where they get unique to each agency. And so something that we do consistently is we never play with our traffic and revenue forecast. If there's something positive or negative that's going to affect our traffic and revenue, we get it into the report. We don't hold back future decisions or future things and wait a while. And I think like COVID was a perfect example. If you remember when we did the October forecast, we had reduced revenue then by my memory, which might be wrong, I thought we were in the $180 million range, and we reduced it because we had things like an increased usage of Maryland Easy Pass, and therefore customers were paying lower tolls. We incorporated the reduction in civil penalty. We incorporated toll modernization. And, you know, no one likes their traffic and revenue to go down, but we don't delay in incorporating those into our forecast. And that's what we've done in the past, and it's certainly our plans for the future. So we try to make these assumptions as close to realistic as possible, with then a layer of conservatism in them.
Thanks. Thank you.
So if there aren't any other questions on this update item, we don't need any action on it. We're gonna, this is our starting point. So this is where we know what our revenues are. The next several items presented by Chris and Jeff and Jeannie, Alan, will take us through actions. And one of the themes you'll see with these actions is we're taking short-term actions to address fiscal year 21 and 22. And then you see us restoring back to where we were for pre-COVID levels, so that we're matching short-term strategies with a short-term issue. With that, I'd like to turn it over to Chris Thompson, who will talk about amending the fiscal year 21 operating budget to reduce it.
Thanks, Deb. Christina.
Good morning.
Good morning, Chris.
So I'm here to request a recommendation of approval for the FY21 operating budget. The amendment is a reduction of $19 million or 5.9%. As a result of declining revenues due to COVID-19 and other customer-focused business decisions, we found it necessary to reduce the operating budget in order to stay in compliance with its policies and legal financial requirements. This budget reflects the reductions necessary to maintain compliance and is a short-term action to align revenues and expenses. The amendment includes the following significant changes. There's a $3.7 million decrease in personnel expenses, including a decrease in pension and unemployment rates as directed by DBM, a reduction in overtime expenses for police and toll collection staff, and the removal of the police step. There's also an increase in salaries and benefits, which are offset by the decrease to fund certain positions that were exempt from the hiring freeze that we took some money out for. There's a $13.4 million reduction in contractual services. This includes $3.1 million in engineers, which could affect our ability to support various initiatives, but we believe we can still maintain our core businesses. A $4.5 million reduction in roadway repairs and maintenance, which may defer some maintenance and may cause more costly repairs in the future, but we will satisfy the requirements of the trust agreement and maintain the roadways in a state of good repair. There's a $2.8 million reduction in IT services, which could potentially limit support to the data center and limit expansion of web services, may impact upgrades to a few systems and defer enhancements. There's a $1.8 million reduction in Easy Pass service center costs. This is an expected savings due to the change in 3G vendor. There's a $70,000 reduction in management studies, which could cause MDTA to delay the work on the asbestos management plan, but we've worked with the Department of Environment and to get an extended deadline. There is a $1.5 million reduction in transponders due to the utilization of existing inventory. There's $0.1 million reduction in supplies, including salt, electrical materials, roadway maintenance materials, uniforms, and office supplies. So $0.5 million reduction in replacement and additional equipment, including deferring servers, ETIX units, and other maintenance equipment. We did need a few increases. There's a $1.5 million increase in statewide telecommunications for MDTA's share of the cost for the radio system. This was something that was not budgeted for. We didn't know about it. And we recently, in the last 6 months, found out that we needed to fund this. A $0.4 million increase in fixed costs, which includes $138,000 reduction in rent, which is offset by an increase of $500,000 for insurance. Again, these are short-term cuts needed to maintain financial compliance, and senior management worked tirelessly with the budget staff to develop these reductions, which we feel are achievable. No different than in the past, if we learn that these reductions are not sustainable over the short term, we will come back to this committee and the MDTA board with adjustments. With that, if you have any questions, I'll be happy to answer them.
Member Ardinger, I had a question. In regards to, and I understood, Deb, if I understood you correctly, with the 3G and the, blinking on the name of the other company that's currently.
Transport cap.
Yeah.
Transport cap.
Yes, sorry, thank you. We're not double, it's not, the cost of using this other service is was already factored into the budget, it sounds like, prior to this. Is there any additional cost associated with the 3G implementation being delayed was it already recognized in the operating budget, or is there a change because of that?
So originally, when the 21 budget was implemented, we did not adjust very much for the implementation, but we knew that CAPS and TransCore operating costs were actually going to be much cheaper than Conduit. We did not adjust the budget for it, so now we are able to do some adjustments to reflect that.
And also, this is Deb, the reduction that you see when we still at this point, based on what we know, expect to start phase 3. That's the acceptance period at the end of this fiscal year. We still at this moment think that that's where we're going to be. And previously, we had accounted for this acceptance period as all operating expenses. Well, this is a lump sum amount that we pay both CAPS and TransCore for that, but it's higher than what normal operations expenses would be, because you're going through the verifications of KPIs and you're working through any more kinks. And there's a lot of extra stuff that you're doing as they're proving the system should be accepted. And so what we did here is we went back and we analyzed and said, based on volumes under a normal O&M period, how much would these 3 months of expenses be? And then we compared it to the lump sum amount, and the difference meets the definition of capitalization. So that's why you see that reduction here, because that delta can be capitalized, which allowed us to reduce the operating budget.
And Deb, the analysis is through what assumption on a date on that? What time period?
Well, the phase 3 is 3 months, so we just consider 3 months. So if we transitioned, before or April 1st, then the operating budget reduction, I'm sorry, I want to go back. I want to say it was 1.6 million, 1.8 million, you know, would be the entire amount. If we are a month later, then that amount is 1/3 overstated as a reduction. But as Chris, you know, because the answer, remember Oringer question, you know, I thought it was a two-part question because Chris answered the first part about had we made other reductions previously, and we had not. And Chris, please correct me wrong. I know you know the budget, you know, better than anyone. Have we historically underspent Easy Pass costs?
No,
Okay,
not
sorry.
typically.
Okay. Let me step back and have we been able to answer the question? I just want to make sure that, you know, we were answering the question about is the delays with 3G, have we accounted for them?
You have, but to Member Von Paris's question, so this operating budget is based on the assumption that the 3G is going to be up and running in 3 months. Is that correct?
No, this assumes that we would enter phase 3 by April 1st.
Okay.
Because phase 3 spans 3 months.
Okay.
And at the time that it was put together, that was the best information we had. If we're wrong and we don't enter until May, then this would be overstated by 1/3. The 1.8 would be overstated by 1/3.
All right. Thank you.
And I guess the accompanying expenses, you know, when we forecasted the implementation, if we're beyond that, did we forecast any other expenses tied to that, Deb? Do you know, or Chris? Like, I guess consulting fees?
The consulting fees, because we're building the system, they are on the capital side. So a lot of these expenses that we're talking about will end up on the capital budget side. And when we do the update, you'll see how we've been underspending. Now, a piece of that is because we haven't been paying invoices. TransCore has not been submitting invoices. But that's on the capital side. So we have two different budgets in work here.
Okay, thank you.
And when does this budget assume that we're going to be finished with the hiring freeze?
The hiring freeze is effective for all of fiscal year 21. You'll see when Jeff presents the FY22 budget, we assume that the hiring freeze ends for fiscal year 22.
Thanks, Chris.
Okay. Does she have anything else on this item?
No, I'm finished.
Okay. Alrighty, well then we will move on. Thank you, Chris. I know it was a lot of work for you and others, the staff and everybody to put this together. Thank you for that, the effort. And we will then move on. Are you okay at this point, Deb, to move on? Or do you want to discuss?
Member Von Paris, I mean, this is the discretion of the board that each of these subsequent items are all approval items. So the board may choose to approve them as we present each item, you know, or you may choose to hear all of the items and then we go back for for approvals for each item. We defer to the board to make that decision.
Any of the board members have any suggestion here, recommendation? No. Okay. Let's proceed then, item by item, right down the line. That's okay.
Okay, thank you.
Thank you. So we will go to item number 7. Jeffrey Brown will be presenting. Hi, Jeffrey.
Hi, good morning. I'm Jeffrey Brown. I'm here to request a contingent approval for the preliminary full year 2022 budget. The full year 2022 budget reflects updated operations that align with the new realities as we emerge from COVID-19. I wouldn't quite say business, normal business operations, but it's back to a more normal setting compared to what we've had in the prior budgets. And you'll see that as we compare. Proposed budget is $335.2 million, which is an $11.6 million increase, 3.6% increase versus the full year 21 operating budget. When comparing this budget to the amended budget that Chris just presented, it's an increase of $30.6 million or 10%. However, when you compare it to the 2021 preliminary budget, which is more of a pre-COVID type budget, the budget decreases by 2.8 million or 0.8%. And we have some tables that kind of help you look through those comparisons so you can see how the impact of. Moving forward, we've set this into 3 major buckets to help us understand what happened with the budget. You have mandated increases, which are really have no discretion over. And then you have some additions and reductions, which were all discretionary spending in terms of budget. Moving forward on the mandated, we had a $6.4 million increase on mandated expenses. There's 1.7 million from DBM, which is due to our portion or MDTA's portion of the state radio system. This is an allocation that has not happened in years past, so this is new to the budget. In addition, the employees and retired health insurance plus Social Security increased. The health insurance was $4 million and Social Security was $700,000. They're both due to the fact that we're hiring freeze in this budget, and as a result, fully funding the vacancies, these types of costs will come along with them automatically. Moving on to discretionary spending, that was an increase of 20.2 million. The key highlights are, again, as I alluded to, filling vacancies due to the anticipation of the elimination of the hiring freeze. That'll increase the budget by 9.2 million. We have the transition to cashless tolling. There'll be some costs associated with that, with increased credit card fees and the greater need for transponders, and that equates to a $2.9 million increase. We had a fleet allowance increase of 2 million. This is to replace the older, beyond useful life, useful mileage vehicles. So that was a 2.0 million increase. The next several bullet points all relate to the IT part of the business. The first is the net app storage array. That's your back-end corporate files, computer files, database, things of that nature. Typically have to upgrade this at least every five years or so. This is due, and that would increase the budget by 1.5 million. In addition, just the replacement of computers that have lived their useful life of 5 and 6 years will increase the budget by 1.3 million. And also the IT anticipates increased contractual services, mainly for supplemental staff and some new tools that they'll be using, like the new budget tool and the health and safety system tool. This will increase the budget by 1.1 million. We have some large equipment purchases for the JFK highway. That's worth about $600,000. Insurance premiums increased by 500,000. We have some indirect costs for police by 300,000, as well as application software costs for 300,000. Then wrapping up the additions, we have education and training is expected to increase by 300,000 and ammunition for the police for 200,000. Moving over to the discretionary reductions, the biggest is talked early in the morning about the transition to the 2 new vendors for the Easy Pass Center or Service Center. That is expected to reduce costs by $7.5 million. The expected normal turnover within the budget is expected to result in a $3.4 million reduction for this year. Engineering costs are expected to be reduced by $2.5 million. This is due to, there's been a definite strategic focus on reducing these costs, number one. And number two, there's been revised inspection requirements that have been approved by the board. And again, that all results in a $2.5 million reduction. Excuse me. The capitalization of the AET work is expected to reduce operating costs in the building repairs and maintenance by $800,000. There will be a reduced need for toll collectors as we go to all cashless, so additional assistance will be down by $300,000. Employee reclassifications are expected to be down by $300,000. Office assistants additionally down by $100,000, same reason as we fully fund vacancies, less need for this, and just some miscellaneous other costs by $100,000. So that wraps up the overall summary of the current budget. I'm happy to take any questions at this time.
Any questions from any members?
Jeffrey, just a quick question about
Sure.
For the increase in budget, how much, if any, of the $335 million is related to let's call it catch-up costs, costs we didn't incur in the current fiscal year because we weren't able to because of the budget reductions?
I couldn't give you an exact number. I can certainly point you, the obvious one, filling the vacancies for the headcount, 9.2 million. Obviously, that's kind of a catch up because we're filling those vacancies, and then the costs that come along with that, with the retiree health insurance and Social Security, that's another 4.7 million. Those are essentially catching up if we're trying to go back to a normal, fully funded type of operating budget. So at least those I could definitely identify. Others, I would have to actually go back in a little bit more detail, but there's certainly some that were deferred through the year that we're catching up. But I don't have a list of all those beyond the obvious ones I just mentioned.
Okay. That's where the big numbers are. That's fine.
Yeah.
Thank you.
Yeah, and the fleet's another one, Jeff.
Okay. Okay. The fleet, the 2 million in fleet for the vehicles that are past their life.
So Member Rosen, in your materials, we have the budget where we're comparing it to the final 21 to the preliminary 22. We could update this so that you could see the FY21 preliminary, which was pre-COVID, and see how it aligns to the FY22 budget. So we can. Would that would be okay? So let me just make sure I'm clear. Would you want the FY21 preliminary, final, and amended, all three 21s, and then the preliminary 22?
I would say probably the one that's our best baseline from which to then project this year. I think the preliminary is no longer relevant.
Well, the baseline to me was pre-COVID. So if we were comparing ourselves to pre-COVID, we would compare FY21 preliminary to FY22 preliminary.
Right, but we're basically, if we're doing this is effectively as incremental budgeting. So we're doing the incremental budget. It should be from what is the new baseline, not, pre-COVID. I'm not sure. Some items are relevant, some are not, or maybe it is. I don't know. That's why I would say include whatever you think so that we can see what our starting point is to looking at going forward.
We will do that.
Thanks.
Okay. Any other questions? All right. And we'll entertain a motion to advance this item to the full board for further consideration, approval.
So move. Member
So
Rosen.
moved.
Thank you. Motion, and is there a second? Okay, Member Carroll, thank you. Motion and a second. Is there any further discussion? Okay, we'll call the motion. All those in favor?
Aye.
Aye.
Okay, unanimous. The motion carries. Thank you, members. And Jeffrey, thank you very much for your presentation and the work you're doing. Appreciate it.
All right, thank you.
We will move on to item 8, fiscal year 2021, and Jeannie Marriott will be presenting. Hi, Jeannie.
Hi, good morning.
Good morning.
I'm Jeannie Marriott, and I'm the Capital Program Manager. I'm here today to ask for the Finance Committee's recommendation for approval of the proposed fiscal year 21 to 26 final CTP. The final CTP was recommended for approval by the Capital Committee on November 5th and will be presented to the full MDTA board for final approval on November 19th. The 6-year budget in the proposed final CTP is $2.8 billion. This is a net decrease of $7.4 million from the draft CTP. And to see how we arrived at this decrease, let's turn to attachment number 1, the CTP comparison tables, draft versus final. Looking at the column titled Total 2021 to 2026, on line 1, we see a $1.1 million decrease in the Nice Middleton Bridge Replacement Project. Line 2 is the I-95 ETL Northern Extension, and there's a $3.2 million decrease in the 6-year period. Line 3 is the remainder of the CTP, not including the reserves. There's an increase of $154.3 million. In line 4, there is a $157.4 million decrease in the reserves. Line 5 is the remainder of the CTP, including the reserves. In line 6, the total of all changes in the fiscal year 21 to 26 time period is a decrease of $7.4 million. To the left in the 2020 column of line 6, we see the fiscal year 20 expenditures were projected at $449.8 million. This amount was amended to $465.4 million in September. The fiscal year 20 spending was $463.6 million, resulting in a $1.8 million underspending of the amended budget. Now, if we turn to attachment number 2, this is a list by project of the changes in the total estimated cost and the changes in the 21 to 26 time period. The first category is new projects added. There were 4 system preservation projects and 3 enhancement projects added for an increase of $7.6 million in the 21 to 26 time period. And please note that the cost of the Maryland 24 northbound auxiliary lane is not listed because it is included in the I-95 ETL Northern Extension group of, group of projects. Next, there were 6 projects modified to add the construction phase, which resulted in an increase of $107.2 million. There were 2 projects completed with a net decrease of $712,000. Then beginning on page 2 and continuing to page 4 are 89 projects that were modified due to cost changes and cash flow adjustments for a net increase of $37.9 million. Next are the reserves that decreased by $157.4 million. And finally, there's a summary of the project budget changes and reserve changes that resulted in the $7.4 million final CTP decrease. Now moving on to attachment number 3, the pie chart represents the allocation by facility of the $2.8 billion final CTP. The Kennedy Highway facility is the largest piece of the budget at 36%, And that's because primarily because it includes the I-95 ETL Northern Extension projects. The Nice Middleton Bridge facility is second at 18% and includes the bridge replacement. Now, if you turn to attachment number 4, this shows the categories of projects funded in the final CTP. Safety and capacity improvements is the largest at 37%. And this category includes, among other projects, includes cashless tolling conversions and many projects from the I-95 ETL Northern Extension. Bridge replacements are second at 22%. This category includes the Nice Middleton Bridge, the I-95 bridge replacement, and bridges that are being replaced as part of the I-95 ETL extension. And I'm asking for your recommendation for approval of the final CTP, and I'd be happy to answer any questions you may have.
Thank you, Jeannie. Any questions from any members?
I'd like to make a motion that we approve the CTP budget.
Okay, there's a motion. Is there a second?
Member Artinger will second.
Okay. We have a motion and a second. And just to clarify, to advance this to the full board for further consideration. The motion and a second. Any further discussion? Okay, all in favor?
Aye.
Aye.
Opposed? Motion carries. Thank you very much. Jeannie, thank you.
Thank you.
You do. Okay, take care.
Member Artinger, sorry, Member Von Paris, this is Chantel Green. Good morning. I just want to, I want to circle back to item number 6. Are we approving item by item, or are we going to wait until the end of items 6 through 11? And I'm asking because we did not approve item number 6.
I apologize. I missed that. And so if it would be appropriate, we'll go back to item 6. If we did not approve that, we'll take that up right now. Kim, is that okay with you?
Sorry, yes, sir, that works.
Okay, thank you. I apologize to the members. We will jump back to item number 6, and we will seek a motion to advance to the full board for approval.
Member Artinger, I move.
Okay, we have a motion and a second.
Second that. Remember Carol.
Carol, thank you. Any further discussion? Okay, all those in favor?
Aye.
Aye.
Opposed? Okay, motion is carried. Thank you very much. And again, I apologize for missing that. I think there's a lot here today. So, all righty. Chantel, thank you.
You're welcome. Thank you.
Okay, we will move on. Alan's there waiting. Hi, Alan. How are you? We'll move on to item number 9 on the agenda, board resolution. Good morning. Still morning, right? Yeah, good morning. I think you're on mute.
Thank you. Got my
There you go.
screen on, but I'm on mute. We're seeking approval for resolution 20-06, or approval to move on to the full board for approval. This resolution would authorize the use of $53 million of unrestricted cash to refund a portion of debt service in fiscal 21 and fiscal 22. This action would be to mitigate the severe short-term revenue declines associated with the pandemic. And the refunding is similar to an action we had taken in 2018 when we used unrestricted cash to defease bonds that were callable. I just wanted to make the distinction between a refunding and a cash defeasance. They're essentially the same thing, but with the 2008 bonds that we paid off, we were doing a defeasance because we were within 90 days of the call date. In the case of the 3 bond issues that we're proposing to refund just a portion of the debt service, not all the debt service, we're not within the call dates. So essentially what we are proposing to do is just set aside cash in advance of the due dates for those principal and interest payments. And the purpose of that is to improve our debt service coverage in those 2 fiscal years. And debt service coverage is essentially net revenues in your numerator divided by your debt service. And with the revenue decline, we don't have a lot of control over that in the numerator, but what we can control is the denominator, which is debt service. So by prepaying that debt, essentially taking cash and putting it in irrevocably, putting in bond service accounts in advance, we'd be lowering debt service in those 2 fiscal years. And I'd refer you to the first table in this item. You can see in the first column is our full debt service that year. That doesn't include anticipated debt service, but a bit over 100 million in each year. And then the proposed amounts are in the next 3 columns. Those are the principal and interest payments for 3 series of our outstanding bonds just for those 2 years. So our 2012, 17, and 19 series bonds. So in fiscal 21, those 3 principal and interest payments total about 31 million. So that would drop the debt service in those years, from about 111 million to 79 million. And it's interesting that reduction in debt service is about 28%. The revenue effect, if you think about it, is essentially double the decline in debt service because we have a board policy to maintain at a minimum 2 times debt service coverage. So that $31 million reduction in debt service yields a $63 million revenue effect. An important point to make is that using the cash in advance of those payments doesn't change the amount of cash that we have available for capital projects or our unrestricted cash position at the end of fiscal 22. And that's because the cash that we would have otherwise been setting aside monthly during these 2 fiscal years for debt service, those monies won't need to be set aside any longer because they've already been funded from unrestricted cash. So that cash from net revenues will essentially flow back into our unrestricted cash position and be available for capital projects. So at the end of fiscal 21, you'd have roughly a $31 million reduction in unrestricted cash, but by the end of fiscal 22, those net revenues would have flowed back to unrestricted cash and you'd be no different. It perhaps begs the question about, if we have this substantial decline in revenues in fiscal 21 versus what was like our last normal year of revenues in fiscal 19, and we're expecting, generally a large recovery in fiscal 22, revenues may be down about 7% versus fiscal 19. The question might be, why do fiscal 22 as well? And I think the answer to that is that there's still a lot of uncertainty about how COVID-19 will play out in fiscal 22, both in terms of, the vaccine and the dispersion of the vaccine. And then also, will there be a lingering recession in fiscal 22? Is there going to be a shift to more teleworking permanently? What are the impacts on leisure travel? We certainly are relying on our TNR consultants to build in some conservatism, but since this cash refunding doesn't cost us anything, there's really no reason for us not to and reduce debt service legally in fiscal 22 knowing that our cash position, returns to normal by the end of the fiscal year. There's another table. The second table shows you the coverage impact. It's roughly about a half times coverage improvement in both fiscal years. So certainly in fiscal 21, that's very necessary to keep us, in line with our debt policy to maintain 2 times coverage. And then it's just helpful to give us some cushion with the great uncertainty in fiscal 22, even though, we're projecting, healthy coverage above that. I think the final couple of points are that, this type of action demonstrates the agency's financial flexibility. We have the ability to utilize our unrestricted cash, which is essentially a reserve, to help in times of stress. Credit rating agencies have viewed these types of restructurings as prudent mitigating actions in response to the severe revenue declines. And this has been, published in several of their reports, and not just in the toll sector, but in a lot of municipal sectors. Issuers are taking these types of actions. One of the other actions that a lot of issuers are taking is that they're essentially deferring debt service by refinancing it. So they're extending their debt maturities. It's sometimes referred to as a scoop and toss, where they'll essentially refinance near-term debt and extend those maturities out. Normally, rating agencies wouldn't like to see that type of action, but they've published that they view it as very prudent, to address the COVID-19 impacts, because it's clearly outside of management's control, and not just the toll sector, but other municipal sectors. And I think, importantly, MDTA is not proposing an extension of debt maturities. We're just proposing this early set aside of funds for debt service. So, while both of those have been termed prudent actions, just the early set aside is a bit more conservative relative to a debt extension. And we would anticipate that, assuming that we receive board approval, on the 19th of November, that we would be making this transfer of about 53 million, around the 20th of the month. I've forgotten one other point, and if anyone's picked up on this, but in the first table, you can see that the sum of the debt service that we're proposing to refund totals 63 million. We're proposing to only move 53 million. And that $10 million difference is because each month we're essentially setting aside 1/12 of debt service. And we've already done 4 set-asides this year. So we already have about $10 million set aside in those 3 bond service accounts with our trustee bank. So that's why we only need an additional 53 million to set aside early. So we're seeking approval from the Finance Committee, concurrence of the action, and approval to move forward to the full board for approval of the resolution. And I'm wondering if I can address some questions.
Any questions?
Member Ardinger. Thank you, Alan. Looks good. Our debt service coverage looks good. I know you also mentioned with unrestricted cash, you've already addressed that we're fine. But specifically, and I can't remember what our requirement is with unrestricted cash, and where are we projected to be in 2022 with this?
Yes, so our debt policy requires that we maintain 350 million of unrestricted cash. And so at the end of October, for example, we had a bit, around 530 million. So, we would be using some of that cash. And then we have another resolution coming up to propose a new financing. So with any refinancing, we tend to reimburse ourselves for prior expenditures. So what you see in the forecast is, frequently at fiscal year ends, we're around 350 million. The reality is that we're often higher than that because, we don't draw down to the last dollar and then issue bonds. We tend to do it, other than last year, typically a bit early, couple of months before we would be drawing down to that 350 million minimum. So when you look in the forecast, you're going to see at the end of fiscal 22 us drawing down close to 350 million. But you know, the forecast is just a model, and what it shows is that, you know, as you draw down unrestricted cash close to the 350 million, you need another bond financing to finance capital projects for the next year. The reality is that, and you'll see that in the next resolution that I have, is that you tend to do financings for periods of a little bit more than a year, and so you often end the fiscal year with a bit more unrestricted cash than 350 million. But that's what you'll see in the forecast, is that we push down to 350 million and then issue again. Does that answer your question about the cash?
Member Arranger, in the next item, when we walk through the financial forecast, when we go to that in fiscal year 21, we expect to end with $419 million of unencumbered cash, and in 22, 370 million is what our forecast assumes. And that incorporates all the items we've previously discussed, as well as the bond resolution sale that Alan just mentioned.
Right. And thank you. And that was my concern, that we continue to always, all our projections with this step, we are above our cash reserve requirement.
And because our cash is above the 350 million, that's what allows us to do a cash refunding, to use the reserves above the 350 million. If we were right at 350, then we might have been an agency like others where the scoop and toss method, where we restructure, refinance, would have been our option. We just don't need to go to that option because of being above our $350 million policy.
Great. So if there are no other questions, we're just seeking approval to move on to the full board for approval of the resolution.
Okay. Thank you, Alan. Is there a motion to move this item to the full board for consideration?
So moved, Member Carroll.
Okay. The motion, and is there a second?
Second, Member Rosen.
Okay, Member Rosen, seconds. Any further discussion? If not, we'll call it. All in favor?
Aye.
Aye.
It's unanimous. Thank you. Motion carries. Thank you, Alan.
Thank you.
Okay, we will move on to item number 10, and Deb will present.
Yeah. So this is the last element of our financial plan that we've been presenting. As I've already said, previously, I'm sorry to repeat myself. I just think it's important that everything we've talked about so far, starting with Chantel when she closed out fiscal year 20 for us, right through Alan's item, is all incorporated into this financial forecast. And I'm going to jump over the summary memo and go to the actual forecast and talk through that, and then I'll circle back to the memo. So when you look at the forecast, starting with revenue, we have highlighted yellow. These revenue amounts, total revenue, they reflect the revenue that was projected in our traffic and revenue forecast. And then when we move down to the blue section with the operating and debt service, if you remember, 304.6 was the amended operating budget that we recommended. To 335.2 was the FY22 budget. And then we grow the budget in subsequent years. And generally this growth rate is a little higher than our actual growth has been. And then debt service incorporates the reductions by cash refunding that we talked about in 21 and 22. And then you see debt service goes back up in 2023, because we only took out series in 21 and 22, plus we have a new financing. And then we roll down into the capital program, and these amounts align with the materials that was presented by Jeannie. And then when we get to, so now we've got total expenses. So, you know, we have the inflow of money in the yellow, we have the outflow of money in the blue. And then the next section is looking at our financing. And you'll see in a minute, we have a bond sale that Alan's going to talk about. It's $400 million. It's the 379 plus the 19.2 million that will reflect that bond sale. We do not have any refundings in 22. Alan will talk about that. Previous forecast, we had fundings in this year. Both financings has been combined in 21, and the TIFIA loan that you see in 23 had been in 22. We pushed that out to 23, and Alan will talk about the reasons for that. And then we come down into the peach area, and this is where we have both our legal rate covenant as well as our policies. So legally, we are confined to $3 billion in debt. And you can see in our reporting period, we stay below the 3 billion mark. We have the $350 million unencumbered balance requirement, and we stay at or above that. We are intentionally holding on to more cash in 21 and 22, but then we bring ourselves back down to the $350 million mark in the later years. If COVID continues to linger and we see a need to hold on to more cash like we have been doing, we can certainly adjust when we get to that point. And then with debt service coverage, we estimate being at 2.5 million in this year, and we're at 3.5 million next year. Now 3.5 is quite high, but that goes back to doing the cash refunding. There's really no negative impact to us whatsoever. And considering the uncertainty with COVID, it made a lot of sense to us and hopefully to you to take that action and, you know, create some cushion here so that we know that we can make it through 22 without any issues at all. Now this 2.5 million, you might be asking, you know, well, what if we don't make some of these numbers here? How much cushion do we have if this got closer to 2? And at 2.5, that's roughly $50 million. So revenue could go down by $50 million. And if you assume operating budget, we spend 100% of the operating budget, we know we'll pay the debt service. So we pay the debt service. We're looking at like a $50 million, float, I guess is what I'd call it, for if numbers don't come in exactly where we're forecasted, and still be able to achieve our 2 times coverage requirement. And our rate covenant requirement is 1 times, which we would be at 2.1 is in 2021, and our lowest is in 2026 when we get to 2.0 times coverage. So this forecast incorporates everything that, again, that we've talked about, and you can see in the peach area how the agency maintains all of its financial standards, and in many years, all of the years actually, with regard to debt service, exceeds our requirement. With that, are there any questions?
Any questions? Okay. Is there a motion to advance this item, the fiscal year 2021 through 2026 financial forecast, to the full board for approval?
Member Ardinger, I so move.
Okay. We have a motion, and is there a second?
Second.
Member Rosen, seconds. Any further discussion? Okay. All those in favor?
Aye.
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 Okay. And opposed? Motion carries. Thank you. And thank you, members, and thank you, Deb. We will move on to item 11. And Deb is still up for that. Go ahead, Deb.
Okay, so with this item, we can certainly look at the summary memo and the stats, which I'll do in just one second. But that item and this item we just did with the forecast, they really relate to each other. And the conclusion is that our revenue is sufficient and we do not need any toll increases during our 6-year reporting period. And we know that because we maintain and we stay above all of our financial measures. You know, when we need a toll increase is when we drop below our 2 times coverage, or our bonds, in order to support the capital program, would need to be above $3 billion. And so because we stay within our standards throughout the reporting period, it means that we do not need a toll increase. And so rather than on this item, you know, we address revenue and what's happened, and I won't go back through that because we've already had the agenda item. We've talked about expenses, but in the summary memo, it just summarizes the exact same information that you just saw and how we stay above our coverage. That this table mirrors that peach section that we just looked at in our forecast. So, and this is a biannual requirement that as a board policy to provide this update. And we like to tie this update with the same time as the financial forecast because of the relationship between the two. With that, if there's any questions, I'd be happy to answer them.
Okay. All right, Deb, thank you very much for the update. And that completes item number 11. And as mentioned in the beginning of the meeting, we are going to take a 5-minute break. It is 11:03. We'll say 11:09. We'll be back here. And I remind everyone to that we're going to ask everyone to please mute their computer, their line, when they leave for a break. Okay. We'll be back around 11:09. Okay, we will resume the meeting. And we have item number 12, Board Resolution 20-07. Alan Garman will present. Hi, Alan.
Great, thank you. Resolution 20-07 is seeking authorization from the board for a new money financing of approximately $400 million. And that would be to finance capital projects for an approximately 15-month period through fiscal year end 22. We anticipate running out of bond proceeds and starting to spend down a portion of unrestricted cash that's in the capital account, and could expend those monies down to our $350 million target as early as March. And it really is dependent on the speed of capital spending and also the revenues, how they're flowing in. But we'd like to get the financing done, and started, in late November, early December, and potentially get it accomplished in February or as late as March. We can always slow it down a bit, but it will be difficult to speed it up much earlier than February. The sizing for this $400 million financing is consistent with the prior June forecast, but it combines the 2 years of financings into one issue. And as you get close to a fiscal year end with the financing occurring, let's say in February or March, it makes sense to combine the financings that are coming up for the next fiscal year, because you're only 3 months away from the fiscal year end. The only significant difference in size is that we had been modeling the purchase of a surety policy, an insurance policy, to fund the debt service reserve. And given the problems in the market associated with the pandemic, it's still difficult to obtain sureties. Just for perspective, we'd had a hard time even getting a bid on a surety in our last bond sale, and now rates for sureties, the last quote I saw was about 5 times what we had paid previously. So it's pretty clear the insurers aren't really looking to write any new business. So it's probably better off to go with a cash funded debt service reserve. So you can see in the table, the only real increase in the financing for the 2 years versus our last June forecast is really just to account for, about 17 to 20 million for a new cash funded debt service reserve. The other point to make is that TIFIA was shown in the forecast for fiscal 22 as a draw. TIFIA had represented a placeholder for us. We know we would need financing in that year, but the TIFIA loan will act as a hedge against rising interest rates for us. So we've been anticipating deferring that TIFIA draw as long as possible, likely toward the end of the Nice Bridge project. And that will allow us to issue municipal tax exempt bonds earlier in this program period. And potentially, if rates are rising, we can lock in this TIFIA loan rate, in coming months, and then hold that rate even though rates have risen. And that's the benefit of that's one of the benefits of a TIFIA loan structure. And also that's the benefit of waiting, is that the loan then acts as a hedge against rising interest rates. The 400 million par amount may be adjusted downward to account for the bond premium. And we also have to size that financing to provide funds to cover the debt service reserve and cost of issuance. So just a rough estimate is the actual par might be down in the $320 to $350 million range, but to generate proceeds of around 400 million those 2 fiscal years, essentially the rest of fiscal 21 and all of fiscal 22. We have, as always with these resolutions, we have limiting provisions. So the par is limited to 400 million. The deadline for the financing is August, and then we're required to come back to the board for a post-sale report on the results. So management is essentially requesting approval and concurrence from the Finance Committee to move this item on to the full board for approval. Are there any questions?
Okay. Any questions? I just have a comment. I think that these are two very smart moves to push TIFIA out is good, and to be able to maintain that rate, that lower rate. I think that's very good, and I also think the method on the surety policy is also a very smart decision. So those are my comments, but okay. This is an approval item, so we will call and is there a motion to advance this item to the full board for further consideration and approval?
So moved, Member Carroll.
Member Carroll. Motion, is there a second?
Second.
Member,
Okay.
Okay. Member Rosen, second. Any further discussion? Okay. All those in favor?
aye.
Opposed? Motion carried. Thank you. Thank you, Alan.
Thank you. Moving right along to Board Resolution 20-08. This is for the TIFIA loan financing. The only purpose really of this resolution is to extend the working authorization deadline from December until August of 2021. The process with the US DOT and Build America Bureau is quite time consuming, at times frustratingly so, but we think it's well worth our while in terms of lower financing costs. So the Bureau, and particularly with the potential change in administrations, I guess, there's some delays at the Bureau dealing with potential changes in administration. So we're just seeking this resolution to extend the working deadline. And this resolution also combines two prior resolutions. We had separate resolutions for the new money portion, which is approximately $210 million for the Nice Bridge project, and then the refinancing portion, which is about $482 million, and that was for the old intercounty connector loan. Just a couple of other points on the refinancing is that the projected savings from the refinancing are significant, potentially $50 million. But there's a great deal of uncertainty with the volatility in the Treasury market. So for perspective, we had locked in that loan rate back in December of 2008 at 2.56%, which at the time was within a couple of basis points of the all-time low for the 30-year Treasury. We've gotten a little bit better or more favorable terms with the Build America Bureau for this loan. Our loan is not just tied to the 30-year Treasury, but we're going to have multiple discount rates. So we're going to potentially use a piece of the loan will be financed at the 10-year rate, and we can use a 15-year Treasury and 5-year Treasury and a 30-year Treasury. So even though we've seen huge move in the 30-year Treasury in recent days, just the last couple of days it's risen by almost 14 basis points. So the 30-year is around to 174. But the 10-year is still around the 95 basis points. So, our blended financing rate should still generate substantial savings. But again, there's a great deal of uncertainty. I just refer you down to the tables. In terms of the key points, the TIFIA loan's a little unique. They are continuously callable at par, which is a little different than our municipal financings that typically have a 10-year call structure. The true interest cost of the old loan is 2.56%. So to the extent that we could drop that by 100 basis points, it would be substantial savings, or 75 basis points. We had been sort of modeling a 1.5% new money financing rate, but given the volatility, it's very hard to give you a very accurate projection. So I mean, just for perspective, with present value savings ranging from, let's say, 4% to 15%, depending on where treasury rates are, that could be treasury rates in the 2.25 to 1.25 for a blended financing rate, and that would equate to nominal savings in the range of $25 million to $100 million over the remaining approximately 27-year life of that refinancing portion. The targeted loan financing or signing, essentially when we can lock the rate, is when we sign the loan agreement, is potentially in spring. That's my hope. And then the limiting provisions of this resolution are par amount limited to $700 million. That essentially combines the new money and the refinancing. We would have to achieve a minimum net present value savings of $1 million on the refinancing to move forward. The final maturity date of the refunding portion would be no later than the existing loan term, which is in 2047. And we would be extending this working time to August of 2021. And then, as with all of our financing resolutions, we would be required to come back to the board on the first meeting after the rate lock. So we are seeking approval and concurrence from the Finance Committee to move forward to the full board for approval. Are there any questions?
Okay. Thank you, Alan. I'm getting feedback on the, so it's difficult for me to focus here. There's feedback on the line. Okay, is there a motion to advance this item to the full board for consideration?
Member
moved.
Artinger, I so move.
Okay, we have a motion. I'm Member Artinger, and is there a second?
I'll second
Jesse?
that, member.
Member Carroll, second. Any further discussion? If not, all those in favor?
Aye.
Opposed? Unanimous. Thank you. Motion carries. Alan, thank you, and you're up again. So we'll move on to item 14. Is that correct? You're up? You're still up?
Yes, that's correct. Clayton and I are going to cover the investment report, and Clayton's having a little technical issue with his video camera, so he won't be blessed with his picture. Anyway, this is our normal quarterly investment report where we come to the board and report on trailing 12-month performance for the investment portfolio. And we also touch on drivers of performance, in the trailing period, and also what we're seeing in terms of the economy and fiscal and monetary policy that may affect returns in coming months. The one newer item that we have is that, as you may recall, back in February, we came to the Finance Committee and the full board, and we had received approval to extend duration for our unrestricted cash accounts. And then COVID-19 hit, and we came back to the board the following month and said we'd like to delay the implementation of that. We're still looking to delay the implementation for the bulk of the unrestricted cash amount, but we are looking to start extending for just the M&O reserve, which is about 50 million or 14% of the total 350 million of unrestricted cash typically held in the general and the M&O reserve. So we'll discuss that more in the during the review of the slides. So I will shift over to Clayton to cover the first few slides.
Thank you. So I will turn to slide 2, and the top left graph. Can you hear me okay?
Yes. Hi, Clayton.
Thank you. Thank you. In the top left, we see the dramatic drop in treasury yields that occurred with the occurrence of the pandemic. Rates are down near zero in the U.S., and they have remained there since March. I would note that within 5 of the 7 G7 economies, rates are actually negative out to 4 years. And some might see that as a risk, some might see that as an opportunity, but the U.S. and the UK in particular have not gone negative yet. Unemployment and payroll numbers have continued to improve since the spring and early summer. And we are seeing increases in economic activity as measured by capacity utilization and industrial production. Moving on to slide 3, the Fed has stated clearly that they are going to be there to support the economy from a monetary perspective in any way that they can, and that their resources are unlimited. During the quarter, they also made an interesting shift or change in their long-term policy in terms of targeting inflation. In the past, they've targeted an inflation rate at 2%. And during the quarter, they said that they would target an inflation rate of an average of 2%. So they're willing to let the economy, they're willing to let inflation run a little bit higher than 2% in order to make sure that things go back to a more normal environment. They have also stated that they strongly encourage fiscal support as well. We have yet to see a second tranche or injection of fiscal stimulus, but I think that will be on the table. And I have heard some commentary that something should happen by the end of the calendar year. Do you have anything to add there, Alan?
No, I don't think so. I just, I mean, what we've seen in volatility in the last couple of days, there's been some, optimism about a vaccine, and clearly that would be positive for the economy. And so, the Fed seems like they're, on hold on the short end, but, there's some anticipation the curve could steepen with an improving, outlook for the economy. So you could see, long rates, rising while short rates remain locked in, but it all remains to be seen. So as always, there's a lot of uncertainty.
Okay, so moving on to slide 4, we see the portfolio and the structure of the portfolio, as well as some of the transactions, the activity. This is an agency-only index, but we do take advantage of opportunities across the market as we see fit and as we have been granted authority via the investment policy. Are there any questions here? So moving on to slide 5, I will turn it over to Alan.
So slide 5 gives a bit of a multi-year perspective on the returns of our benchmark index. And, what you would observe, or I draw your attention to is, as rates rose, following the last financial crisis, you've got the income component of your return, which is essentially the coupon income flowing into the index. And then you have the price return. And so, with premium structures, the price return as the bonds amortize toward par at maturity can be negative and subtract from those coupon incomes. And then particularly in years where you get sharp increases in rates like you saw in 2013, that coupon income, may be less than the price change. So that's what happened in 2013. In 2019, we had, a substantial decline in interest rates, and that's occurred for 2020 as well. So year-to-date returns for the index through early November are again above 4%. So, that's the expectation for all of calendar 2020. But, we just want to set expectations correctly that prevailing yields on the index are well below 1%. So from an average return expectations perspective, that's the expected return for the next few years is below 1% return. So while our return will be very healthy in 2020, it's likely to be well below 1% for the next few years. And I'll turn it back over to Clayton for slide 6.
Sure. Just to add one point to slide 5 and the performance as we get into it, the return on the portfolio or the index as well was about 34 basis points for the 3 months, 36 basis points as I go to slide 7 actually. And our portfolio did 51 basis points. But going back to slide 6, you can see that for the most recent 6-month period, the bars in yellow, for the most part, exceed those of the blue being the index or the benchmark, and the yellow being the portfolio. Prior to that, the prior 6 months, there was some modest underperformance attributable to some shorter duration as the tendency for the non-agency sectors to lag. To slide 7, highlighted the return for the quarter for the benchmark in blue near the top left, and the index at 51 basis points. To Alan's point, the 12-month return for the portfolio 493 versus the benchmark of 499. And then over to the lower right, you can see how we are positioned in duration terms, and duration being essentially the interest rate risk of the index or the portfolio, slightly underweight duration. Moving on to slide 8, we can see the portfolio maturity distribution. I think the item that's most notable here is the large allocation to cash, the 0 to 1 year bars over on the left for the beginning and the end of the quarter. And we're heavily weighted into cash there because we do anticipate, as has been discussed earlier, we do anticipate capital and construction needs to reduce that allocation. On to slide 9 and 10, we have the compliance report. I think the most important for your members is the fact at the bottom of slide 10, the compliance. We have been in compliance with the investment policy for the period and are happy to report that. This also provides the maturity constraint that we have on the debt service, the bond service, as well as the unrestricted. We're in compliance there, and then a breakdown by issuer following at the bottom and the next page. On slide 11, Alan, would you like to cover this?
Yes, thank you. Yes, slide 11 shows the unrestricted counts in the table on the top. You can see the general M&O reserve and capital accounts represent our unrestricted cash positions. The general and the M&O reserve are held, above 350 million at fiscal year ends. And you can see we've been benchmarked against this composite index, which is essentially an index of 1 to 5 year agency securities. And that's been the index for the upcoming quarter as well. The capital account, as always, is match funded, meaning that we're trying to match our investment maturities to precede the expected, cash flows in that account. And then situation with the debt service reserve is that in prior years, we've used a slightly longer benchmark, 3 to 5 year index for debt service reserves. in the midst of these, all-time low interest rates, we had funded a debt service reserve with the last bond sale, and we received board approval to maintain that portfolio, relatively short with less than 1 year maturities. And the thinking is that we're waiting for, sort of the COVID-19 issue to resolve, which is, depressing rates. And we're a little reluctant to invest $30 million at all-time low interest rates with the possibility that rates could move sharply higher in just a few months. So that's the continuing recommendation for the debt service reserve, is to hold that 30 million short. Back in February, again, we had recommended a change in strategy, and we were essentially accepting a bit more return volatility in the portfolio for expected higher average annual returns. And we provided a lot of detail about the rationale for that in tables, but essentially we received approval from the board, and then we came right back to the board because of COVID-19 and said, well, we're not market timers, but we really don't want to extend a $350 million portfolio, in these record low interest rates. So we've been on hold for several months now, and we've been returning to provide updates. With the possibility of a sort of protracted recession or lower economic activity that might drive, with other factors, rates to remain low, we're thinking about tiptoeing out in terms of duration. That is, the recommendation at this point is to extend out only the M&O reserve, which is about 50 million of the $350 million unrestricted cash position. And in line with that previous recommendation, we would be structuring staggered maturities from 6 months out to approximately 15 years. And the performance would be measured against a new composite index, which has a similar duration to that structure. And that index would be a US Treasury strip index from 1 to 13 years. So that strip index would simulate the same return volatility, our portfolio structure. The yield differential between the two indices, our current index, which is the 1 to 5, is about 39 basis points. So in theory, that would be a return pickup of about $200,000 annually. That's the positive side. The negative side is that the effective duration differential, implies significantly more return volatility, associated with changes in interest rates. So the negative price return volatility of about 4% for a 1% upward move in interest rates. So I guess to put it in perspective, though, is that we're talking about moving out about 14% of the unrestricted cash relative to the whole 100% of 350 million. And in terms of the implementation of the extension, is that typically we would implement a duration extension relatively quickly, but I'm not sure with the volatile market, we might be able to take advantage of, movements in the market and do it a little bit more slowly. One of the ideas that we have for the M&O reserve is to take advantage of, heavy municipal issuance. We're a buyer of taxable municipal bonds. And I think, as Clayton alluded to, they can help our returns quite a bit when you're picking up additional yield over agency securities. So, other municipalities are issuing because they have substantial revenue declines. And so at times we can find relatively cheap municipal new money financings and take advantage of that. So that's something that I would anticipate that we'll be able to do. And another benefit of extending duration is that it's the same with our financings, is there's more principal structured in the later maturities and much less to choose from early on. So you're fighting for an allocation to a new financing when you're trying to buy in the 1 to 5 year space, and there's a little more supply as you move out the curve. So we could potentially get a few more bigger pieces at attractive rates. And I think to go back to the performance that you saw in chart, I guess that was on a prior page, page 6, is that you saw that we were lagging the index in the January through March period. And that, as Clayton indicated, that was partly because of being shorter duration, but it was also that as rates fell, bond prices appreciated. And because of our exposures to municipals and supranationals that we had initially bought at higher yields, as rates fell, those markets didn't fall as quickly. So we lagged. And then what you see in the later months, in May onward, then munis started to outperform in that 1 to 5 year part of the curve, where they were starting to catch up in terms of price appreciation with the agencies. So they really helped us there. So potentially those are things that could help us as we extend duration, is that we can opportunistically buy some new issue muni financings to add to the portfolio, and that might help cushion returns if rates were to rise. But also we can kind of selectively or slowly extend duration out. We don't need to do it all in 1 month, but it will make benchmarking a little bit more challenging. We can look and see what's happening in benchmark and also the new benchmark, and as we extend, we should be somewhere in between. The slides that follow, where we normally just include them for informational purposes, but I'll just run through a couple of them quickly. Slide 12 shows you sort of a picture of the different categories of accounts and where we were at the end of September. In the capital account, you can see we had about 170 million. And then the construction account, we were spending those monies down. I think at the end of October, we were down in the $50-ish million range. And that ties back to why we need a financing, is that potentially we can deplete both of those accounts around the March time period. So that's why we need a new money financing. And then below that, you see the $30 million debt service reserve. Slide 13 shows your trade allocation by dealers. For several years, Wells Fargo has dominated the short agency trading space. And this is something that we've talked to State Treasurer's Office and other peer agencies, and they're seeing the same thing, as well as our municipal advisors. They have trading operations, and so Wells Fargo is dominating everywhere essentially. But you can see the other firms that we've traded with, both on the purchase side and the sale side. Slide 14 just discusses the total return strategy versus matched funding. And slide 15 discusses relative value, essentially why we buy municipal bonds and supranationals in the portfolio in addition to U.S. government agencies. So I want to go back to slide 11 then and open it up to questions about the recommended change in strategy. I mean, in theory, this strategy was already approved by the board, but then in February, we went back in March and asked for approval to not implement the strategy. So we're sort of back to requesting that we move forward, but in a slower pace, moving only the $50 million portfolio out, which is about 14%, holding constant with the other portion that's in the general account, and then doing it over probably what will be a couple of months or longer as we opportunistically extend that portfolio out.
Just one question. When you reference investments we're looking at, particularly looking, for chasing a little more yield and looking at munis, I imagine we're not the only ones out there looking at that or considering that strategy for yield. How do you expect that to impact the yields that we'll ultimately achieve? And I agree that that's a prudent investment options since treasuries are so low right now.
If I understand you correct, your question is that, like the difference in the two indices, the old indice versus the new is, it's modest. And so that, maybe is additional income of only 200,000, but that's sort of average expected, additional income in the short run, and a short run meaning like, let's say over the next year, we could readily underperform, the older benchmark, and the investment portfolio, at least that portion of it, let's say if interest rates rose very quickly by 1%, that portfolio could decline by, let's say 4% because of the duration lengthening. On the municipal front, we typically look for munis that are yielding about 20 basis points more than comparable maturity agencies. So in addition to the yield pickup because of extending duration, you could also benefit from picking up additional yield because we'd have the opportunity to buy, more taxable munis, at attractive yields relative to U.S. government agencies. So as rates rise, if spreads, move, we could, potentially cushion some of that blow of the rate rise because, we're picking up additional yield in the munis. But, there's certainly a trade-off. But I think what we had communicated back in February for the rationale is that you're accepting much more return volatility in the short run, but over several years, Clayton can probably jump in here, but we had provided some data that looked at relative returns for, say, the 1 to 5 year index versus this longer index. And certainly there are periods of 1 year where the shorter index outperformed the longer index. And there were also rolling 2-year periods where the shorter index outperformed the longer index, essentially in rising rate environments. But as you pushed out into 3-year periods, it gets mathematically difficult for you to underperform because of that additional yield. And in a rising rate environment, essentially that income starts to offset the price changes. So essentially what you're getting with that longer structure is that you're accepting more return volatility with the expectation over multi-year periods, you're going to outperform and generate more income for the agency. So, and I think back in February, we also tied that somewhat to the financing program, in that, when rates fall, we can take advantage of it on the financing side. And in some ways that offsets some of the risk that we're taking on the investment side because, we're accepting or we're achieving lower financing rates now, and then on the investment side, potentially we're exposed to a decline in investment returns because rates rise. And then the opposite would be true essentially when, rates are high and they start to fall, is that our financing costs could go up, but we might generate a little higher returns on the investment side.
I would only add, as we trade with dealers or open relationships, we are required to share our investment policy. And so the dealers have access to the investment policy for all of the investors in this space. And they'll tell us that most institutions are limited to the 5-year maturity. And so as we consider extending duration, we're in an opportunity set where there just aren't very many players. And so the competition becomes much lower for, 5 years and out, municipal paper in particular. In fact, the other day we saw a deal it was a AA deal, but it was a 15-year piece of paper for 2.65% on the yield, which is 115 basis points over where the 10-year Treasury is today. Now, granted, that's a different maturity, but there's quite an opportunity there to go out and much less competition from the institutional investor space.
Okay. Okay. Anything else at this point? That's your report and update, Alan?
Yes, I guess
And Clayton?
what we're seeking really is to move to the full board, which is normal, but we'd like some concurrence from the Finance Committee to move forward to the board, which is basically to go back to the previously approved recommendation to extend duration. But in this case, it's an extension of duration only for, a portion of the 350 million, just the M&O reserve, which is a $50 million account. So we'd like a concurrence and a recommendation from the Finance Committee to move that recommendation back to the board, to the full board.
Okay. Since it's not listed as an approval item, I want to ask Kim to weigh in on this, if you don't mind.
Okay.
Hi, Kim.
Hello. So yeah, so the agenda doesn't categorize it as an approval item, but I believe that's what Alan's seeking, is an approval to move to the full board. So you should go ahead and take a vote on it. And then assuming you approve, when it goes onto the board agenda, it will need to be listed as an approval.
Okay. All right. Thank you. Okay. Is there a motion to advance this item to the full board for consideration?
So moved.
Okay. Member Rosen, second.
Member Artinger, I second.
Okay. We have a motion and a second. Any further discussion? Okay. All in favor?
Aye.
Aye.
Okay. Opposed? Motion carries. Thank you. Thank you.
Thank you.
All right, we're moving along here. We have a couple of, I'm sorry, there's a full agenda here. We're just about through though. Go to Jeannie or Jeffrey. Jeffrey.
Yep.
I'm sorry.
Yeah.
How are
That's
you?
okay.
How are you?
Good. I'm good. I'm ready.
Sorry, I jumped the gun again.
It's a long meeting.
Okay.
Yes. Okay. Thank you.
Thank you.
Okay, I'm here to provide an update or the status of the year-to-date spending for the full year 2021 operating budget. As of September 30th, we were at 15% of the budget was spent compared to a target of 23%. All of the objects, well, really only with the exception of 3 objects, all objects were below the targets. The 3 objects that were not are communications, which is object 3, which was at the budget spend essentially. Salaries and benefits, objects 1 and 2 were at the budget spend as well. And additional equipment or object 11 was the only one well above spending targets. And that was because of a one-time expense that was anticipated to be in 2020, but occurred in 2021. And I'll talk a little bit more towards the end on that. For all the others, really you can boil it down into 4 major categories. Timing, essentially invoices coming in at different timing, so not seeing the full impact yet. Seasonality, some expenses typically occur at different parts of the year. The COVID-19 impact and just other actions maybe taken by management that reduced costs. So going through some of these, the travel, object 4 is below budget. Travel is one of those still limited due to COVID-19. Object 6, fuel and utilities, is below budget. This is one had some seasonality. We expect some more cost more towards the winter months. Additionally, there were some timing or invoice delays. Object 7 is below budget. Again, winter plowing season, that's typically when more expenses occur. Plus there's some new vehicles, so that requires less maintenance. And COVID-19 in this case reduced some of the activities as well. Contractual services are below budget. There's a listing of them. The key ones are advertising, object 801. That's primarily due to the delay in the 3G go live date. And there's some summer campaign expenses that don't occur until later in the year, so you have some seasonality as well. Building and repairs were below budget. Again, typical expenses for these come in more heavily in the 3rd and 4th quarter. Training is down as well. There's been a focus on trying to reduce this expense. In addition, the limiting of travel and a lot of online training has reduced this cost as well. Management studies and consultants are down. There's been a focus to reduce these costs going forward. Security services, this is more dictated by the level of spending for service repair requests, things like security cameras, scanners, things of that nature. Physical services, this is primarily the Easy Pass retail fees, and they're down, again, associated with the reduced traffic around COVID-19. You have less credit card processing, and as a result, there was some delay in the NOTDs as well that reduced it. Really, the next three bullet points, you have many IT-related contractual services. You have the Easy Pass service center costs and other contractual services. Almost all of these were down as well, but primarily due to timing. Some of the costs haven't come in yet. Some of the major invoices for the Easy Pass didn't come in until the end of October. So you have timing of invoices impacting these specific objects or sub-objects. Object 9, supplies and materials were down as well. The Easy Pass transponders, here we're trying to work through our current inventory, plus we're anticipating reducing cost in this area going forward. And that showed up in the amended budget as well. Salt is kind of an obvious one. That's a heavily seasonal item, so that was down, and roadway maintenance and materials were down due to the lower traffic volume again. So there's limited maintenance activities and greater use of on-call contractors. Finally, the replacement equipment, object 10, is down. Most of this equipment will not be ordered until later in the year. Replacement equipment, I'm sorry, I think I just said that one, sorry. Additional equipment, that's the one object that was above budget. This was due to some HR scanners. They were expected to be spent and expensed in last year, but they did not occur until this year. So that's that item. Finally, the fixed objects was down, but that's primarily due to insurance payments. Again, typically those payments occur in the second or third quarter. So that's what's driving that underspend. So again, kind of to review, it's really a lot of timing of invoicing, a lot of seasonality of expenses when you expect it, and then a little bit of the COVID-19 as well around some of these objects. So that concludes my update. If there's any questions.
Any questions? Okay. Jeffrey, thank you very much for the update.
Okay, thank you.
Thank you. We will move on to item 16. There's Janie. Hi, Janie. How are you?
Hi. I'm providing an update on the actual fiscal year 21 capital spending against the fiscal year 21 capital budget in the fiscal year 21 to 26 draft CTP. This information will also be presented at the board meeting on November 19th. Capital spending in the first quarter was $77.2 million, or 14% of the budget of $543.4 million. The first quarter percentage is typically low because there are outstanding accruals for work completed in fiscal year 20. 85 of the 105 projects budgeted in fiscal year 21 were within the acceptable spending limits of 0 to 50%, which is plus or minus 25% of the 25% target. Due to normal lags in invoicing, generally 2 months, a plus or minus 25% threshold is reasonable. Now, if we look at attachment A, this table lists the 7 projects that are budgeted for more than $10 million each in fiscal year 21. And the first quarter spending for these 7 projects was $46.4 million, which is 60% of the total first quarter spending. And I thought it was interesting to note that the Nice Middleton Bridge alone is 36.5% of the total budget for the year, and that the budget of these 7 projects added together represents 61.5% of the total capital program budget. And do you have any questions?
Any questions?
Okay, well, this was just an update, so we don't need any vote.
It's an important update, and we thank you, Jeannie.
Thank you.
And we'll go back to Deb on item number 17, quarterly update on traffic and revenue.
Good morning, well, good afternoon. It's exactly 12. Myself and Cheryl Lewis Orr is going to present this item. This is the last of our quarterly updates, which is something that we talked about when we were approving the financial forecast and the need to continually monitor budgets and revenue. So this item is a little different than how it's been presented in the past. This is an example where not transitioning is impacting our visibility for where we are from a revenue perspective. So in this item, we're breaking it down into 3 pieces. The first is, where are we in relation to COVID? We've talked about that a little bit before. The second part is, where are we compared to last year? Cheryl will take care of both of those items and present them to you in just a second. And then the last part will be where we talk about revenue in relation to the forecast. This particular item, we figured what we were going to do is walk through the CDM Smith and refer you to different tables throughout the report. So with that, Cheryl, do you want to get us started?
Sure.
Cheryl.
Hi. Okay. Thank you. Let me get my notes here. Okay. Give me 1 second. I'm trying to get it. Okay. So, good afternoon. My name is Cheryl Lewis Orr, and as Deb mentioned, I'll be presenting along with her the update to the first quarter's traffic and revenue results, and I'll be referring to the attached first quarter fiscal year 2021 traffic and revenue performance update report prepared by CDM Smith. So as expected, during the first quarter of the fiscal year 2021, traffic and revenue decreased significantly compared to the prior year due to the COVID-19 pandemic. For this quarterly report, CDM Smith performed an analysis using our most recent available daily in-lane traffic to determine the impacts on traffic due to the COVID-19 pandemic so far. The analysis methodology used and is outlined on page 4 of CDM Smith's first quarter fiscal year 2021 update report. The results of the analysis are shown in figures 1, 2, and 3 on pages 6 and 7 of the report. As you can see, figure 1 is for legacy facilities, passenger vehicles. Figure 2 is legacy facilities, commercial vehicles. And figure 3 is the ICC and ETL transactions. And as you can see from those figures, the peak COVID-19 impact on all facilities was reached in mid-April. From mid-April through July, we had a steady recovery in traffic, which occurred due to the phased in of our reopening of our economy of Maryland. As shown in figures 1 and 2 on page 6, since July, the estimated impacts for the first quarter of FY21 have remained relatively stable for the legacy passenger cars at about a negative 18% impact, and for commercial vehicles at about a negative 3% impact. Figure 3 on page 7 shows overall that the ICC and ETL transactions first quarter fiscal 2021 followed the same trend and has remained relatively stable since July at about a negative 40% impact. These traffic levels align with the traffic and revenue forecast issued by CDM Smith, which was presented in item number 5. So moving on to our actual monthly paid transactions, which is in table 4 on pages 9 and 10. They show our actual monthly paid transaction results for the legacy facilities. And for the first quarter of fiscal year 2021, passenger cars are 30.9% below the previous year, and commercial vehicles are 12.3% below the previous year. Now, this variance from the 18% and 3% mentioned above in the CDM Smith's analysis is most likely due to the delay in processing iTolls. And we'll get into more detail, or Deb will get into more detail about that in her presentation. Overall, the video transactions are down 72.9%, which is mainly due to the delay in the mailing of notice of tolls due. Table 5 on pages 12 and 13 show actual monthly revenue results for the legacy facilities for the first quarter of the fiscal year 2021. And we see that passenger car revenue decreased 28.5% and commercial vehicles decreased 9.2% compared to fiscal year 2019. Overall, our video revenue decreased 74.6%. And once again, these trends are consistent with the consultant's traffic analysis discussed above. The tables on page 14, tables number 6 and 7, show our actual paid transactions and revenue for the ETL. For the first quarter of fiscal year 2021, transactions are down 45.9% and revenue is down 42.9% compared to the same period last year. Trends in the first quarter fiscal year 2021 are mainly negatively impacted by the COVID-19 pandemic. For the ETLs, the delay in mailing of the notices of tolls due is having a minimal impact on the I-95 ETL lanes due to our high electronic toll collection share on that facility. This trend also is consistent with the consultant's traffic and revenue analysis discussed above. So unless you have questions, I'll turn this over to Deb to present an in-depth analysis of the revenue impacts for the first quarter of fiscal year 2021.
So when talking through Sure.
Oh, I'm done, unless you have questions.
Yeah. Cheryl, will you mute, because I won't have the echo. Thank you very much. So when talking about the revenue and where we are in forecast, and in all the prior years, I have always said what's important is where are we in relation to the forecast, not necessarily where are we in relation to the prior year. And so, the forecast shows us from a revenue perspective as being under forecast. Now, there's a reasons for it, and this is an example of an item where we do not have all the pieces put together right now at this moment. So we're presenting you with the information that we do have, and then we'll be following up with additional information when we're able to reconcile the difference. And so let me start by, whenever we have a transaction in the roadway, a transaction is either a transponder read transaction, so that the transponder, the EasyPass transponder reads, we call that an e-toll, or it's an image toll. Now, an image toll doesn't necessarily mean it's a video toll. It has the potential to be one, but at the time of travel, it's either an e-toll or a potential image toll. And what we do with all the image tolls, and this is under normal operations, the first thing that we do is we go and we check Maryland EasyPass account holders and see if that license plate that we recorded belonged to a Maryland EasyPass account. And if it does, we post that transaction to their EasyPass account. Now, on these reports, when we do that, it all shows up as ETC revenue. The E-tolls and I-tolls are combined into ETC revenue. Now, after we do that check, the next thing we do is we send the plate information out to the rest of the EasyPass network with all of our EasyPass member agencies to see if that license plate belongs to any of their accounts, and then they post on those. So this report that is not capturing those transactions, because initially, starting in July, any image-based transaction we moved to CAPTCH, anticipating that the transactions would be sent to TransCore for processing. Well, we have since been moving those transactions over to Conduit to process, but as of right now, they those I-tolls have not posted. So then when I look at these numbers, and I'm referring to page 18, table 9, which starts with legacy facilities, and you can see that from a forecast perspective, we are under forecast for ETC by $6 million for passenger and $3.5 million for commercial. And our next step is to take the transactions from a combination of the I-tolls that Conduit has begun to process for July, as well as analyze the transactions that have not moved over yet, to be able to estimate the percentage of them that are I-tolls. We'll then be able to use that and judge, how far in front of or behind the forecast we are. So when presenting this item, we wanted to show you what information we do have at this point in time, rather than deferring this item until we're able to answer the I-toll question as well. But this is an example of where the transition delay is impacting us because those I-tolls have not been processed, as well as the video transactions that we've talked about previously. And then when we move to the next page, which is a continuation of table 9, where it looks at it on a total basis. So on a total basis for the legacy facility, it's 9.6 million. And then when we go to the final table 10, the difference is 258,000. And again, like, you don't see the I-toll impact like you do in the legacy facilities, because as Cheryl indicated, we have such a high e-toll penetration rate. So let me pause and see if I can answer any questions.
I don't think there are any questions. Are there any questions? No. Okay. I do know a couple, some people have to get going, but because of some other commitments, we ran over a little bit.
So we will continue to provide updates, at least on a quarterly basis, if not more frequently.
I think that's important. I do.
So now, one more thing just to add on this is, you notice the forecast does not include ICC transactions, and that is because the transactions that are with CAPTCH also include trip construction, and 100% of ICC transactions involve trip construction. So we will be able to have data on that as well as these transactions move over to Conduit and we process. The reason that there's a certain level of comfort with this is because the traffic is exactly where we forecast it. So this is a product of not processing yet, as opposed to traffic being below where we had forecasted. So Member Von Paris.
Yes.
When this was our last agenda item.
Yes.
And, you know, if I would like to just verify, there was a couple items of information that was requested, and I'd like to confirm that to make sure that we provide the information that was asked for.
Sure.
The first item that I had involved video receivables, as well as the bad debt. And I guess something that I should have made clear if it wasn't, is when we book the receivable for video tolls, we only did so for video. Any type of civil penalties, that's still maintained on a cash basis, which is standard in accordance, it complies with GFOA rules. So the shift was only with regard to video tolls. So it was requested that we provide information regarding that receivable as well as the bad debt or allowance for doubtful account. The second item that I have that was requested was related to the FY22 budget, and we will expand the schedule that was provided in the materials and also include FY21 information, so that there can be a comparison at the sub-object or line item basis to see the budget returning back to more of a normal operations. That's the two items that I have that's been requested. If I accidentally missed any, if you please let me know.
I don't recall any other items that were requested. Any comments from the members on this? Okay. Okay, go ahead. I'm sorry, Cindy.
This was not requested, but I think it's probably going to be included, Deb, from now on. But if we just, in our monthly updates, if we could just know where we are in regards to this 3G implementation, and if there's going to be any impact from that implementation on the operating or capital budget to the actual.
Okay, so our plan, if it suits you, is we were going to provide an update on 3G at each scheduled board meeting. So on a monthly basis, we were going to provide that update.
You're on mute, Cindy. I'm sorry.
You're on mute, Cindy.
Here we go.
Sorry, that's what I'm at my best when I'm on mute. It just from a finance perspective, if there's going to be any impact from the 3G to the budget versus actual on operating or capital, if you could just let us know.
If there's budget impacts because of 3G, we'll certainly bring that to the finance committee first. The update at the board meeting will be more project-wide implementation. But if there are financial impacts, we'll start with the finance committee.
Thank you.
Yeah, this is Jim Ports. Let me see. Turn my there you go. Video on. Except for the fact that, Deb, you know, we are looking at trying to determine how much of an impact the conduit contract might be. So we may want to start with the board if we do find out that information or verify that information.
Okay. Any other comments here, or is that? Oh, let's see. I think Deb, you still there? You still there, Deb? Oh,
Sorry,
on mute.
I'm muted.
That's,
Sorry about
there
that.
we go. All right.
Yes, aye.
Do,
Yes.
anything else on this item, or are we?
No,
We're good?
no, sir. No, sir.
right.
This item, we're finished, and just before we concluded, I wanted to verify the additional information that was requested.
And I think we're satisfied with that verification. Well, that is it. We actually made it through. There's a lot on here, there's a lot going on at the authority, and there's also a historical, I guess, part of history. It's always, November seems to be a pretty heavy agenda. So that's all we have. Is there a motion to adjourn?
I move.
Okay, and a second. All right, we're all there. We're going to motion to adjourn in a second. All in favor?
Aye.
Aye. We are hereby adjourned. Thank you all very much.